Hello, welcome to Financial Management Business 365. I am Dr. Matthew M. Winter. I will be your instructor this year, and I'm very excited. So let's jump right in. Welcome. A little bit about myself. I taught investments for a number of years in Chicago. I then worked as a visiting scholar for the US Security and Exchange Commission, the SEC. As a visiting scholar, I worked in the Office of Litigation Economics and also in the Office of Corporate Finance. So I served as an expert witness on economic and financial cases for the US. And I also wrote laws concerning corporate finance and how markets are governed. Specifically, I focused on private markets, so about a $2 trillion market. So I've had a ton of experience in the application of corporate finance. The research that I publish is in international finance, so hopefully I'll have a chance to kind of bring some of that perspective in, but really the whole purpose of this class is for you to learn the stuff that I'm passionate about and take that information and run with it. So the best way for us to communicate will be via email. My office hours are going to be from Tuesday from 1 p.m. to 2 p.m. via Zoom or by appointment. Okay. So the course webpage is going to be on Blackboard. It'll have everything, course announcements, lecture notes. These are pre-recorded lecture videos, YouTube links to the pre-recorded lecture videos, all of it. Everything will be on Blackboard. You'll submit your homeworks to me via Blackboard. You'll submit your case studies to me via Blackboard. You'll see your pre-assigned groups. Once we pass the drop ed deadline, everything will be on Blackboard. The course materials. So the required course textbook is listed in the syllabus. It's required in the sense that it would be helpful for you to have access to a book that does a good job of explaining these things from a different perspective. You can use an older version of the book. You can use an international version or an electronic copy. So you can save money in different ways, but it's important for you to still have a book so you can see some of this stuff from a different perspective. You will have Excel case studies. You'll have problem sets that involve Excel. The expectation is for you to get your hands on some real world data and to use that real world data to help you prepare for the real world and for applying corporate finance beyond the classroom. You'll also have homeworks that are that are way less involved, but are individual, and that's going to give you a chance to practice the material along the way. Okay, and lastly, I do want to mention that you will have a case study. Again, you'll work in your pre-assigned groups, and as you work on these case studies, you'll have to produce a case study report, and I'll give you plenty of information later on in the semester to help you prepare for your cases. So the whole point of all of this is to kind of make sure that you understand the basics of finance, then you can apply those basics of finance to financial decisions for the firm. And as you apply those financial decisions, hopefully you feel comfortable enough to explain this stuff in simple terms. Okay, what's expected of you? I expect you to complete the required readings for the lecture of the week prior to the beginning of the week. So I expect you to read the book chapters. I expect you to watch the lecture video prior to the week. So the lecture video will be posted on Blackboard. There'll be links to it on YouTube, very accessible. And in the video, there will be problems for you to work out. So as you work out those problems, I want you to pause the video, work through them, see what's giving you trouble, all of it. Again, you will have weekly assignments that are kind of reflective of that. That'll just give you a chance to practice and apply the material. And then you'll have more involved problem sets that require you to use Excel, and you'll work in groups on those. Suggested but not required material, financial podcasts are a really easy way to kind of stay up to date with what's happening in financial markets and economic policy. The Indicator from Planet Money is one that I enjoy, but there are tons. So what's expected of you? I expect you to do the readings, the books, the handful of news articles. I expect you to do the homework assignments. Your lowest individual homework assignment is dropped. Your lowest problem set score is dropped. So I expect you to do these things and to work on them and to put effort into them. I also expect effort and really a good job on these Excel cases and on the memos that you'll be writing. And like I said, I'll give you plenty of time beforehand to understand what I'm expecting for these cases. And then lastly, I do expect you to comply with the Stony Brook Honor Code. So don't be foolish. Don't put yourself in a position to violate the honor code. Just, it's an ethical school. We're a professional school. So I expect us all to behave with a certain professional manner. What tools are we going to be using? Obviously, finance. We're going to discount cash flows. If it's been a while since you've discounted cash flows, or if it's been a while since you've seen perpetuities and annuities, our next lesson is going to be all about revisiting those tools because we're going to be discounting cash flows over and over and over. We're also going to be looking at pricing stocks and bonds and also options. And lastly, we'll take the CAPM and the WAC, and we'll be applying that over and over as well. So all of these things, we're going to take time to build brick by brick to make sure that we're all on good foundation. Accounting. You're going to look at balance sheets. You're going to look at income statements, statements of cash flows. We're going to make pro forma balance sheets. We're basically going to do what you would do if you worked in corporate finance. Stats. We have to use statistics to put numbers to these concepts. So our average, our mean, our standard deviation, our covariance, we're going to use these tools to basically quantify and identify risk. And then lastly, throughout all of this, we're going to be applying economics. So supply and demand, asymmetric information, basically, you know something that I don't. How do we solve that problem? It means that when you do something, I might treat it as a signal of the quality of information that you have. I might also be apprehensive about some of the things that I observe you doing. So we'll go through all these different examples. And then lastly, competition. We'll think about what happens in a competitive market as we look at this from the perspective of a financial manager who's trying to make decisions. What can you expect from me? You can expect me to provide you with a high return on your investment. So it's not only about ensuring that you get a good grade in the course, but I really want you to be prepared for the real world. I want you to take this knowledge, take this information, put it in your brain, and then share it. I want you to be able to apply it when you have a job interview, if you have an internship you're going after, if you're interested in a line of business, if you're starting your own business, if you're just having a conversation with a parent or with a grandparent or with a sibling, a coworker, whatever. I want you to be able to have this knowledge comfortably sit inside your brain and then apply it. So we're going to do plenty of examples. The whole structure of this course is designed for you to be able to ask plenty of questions during class, after class, via email, during office hours, the whole nine. So what is this course about? We're trying to understand the key concepts of corporate financial decisions. So you're going to look at the weighted average cost of capital. We're going to do quite a bit of capital budgeting. We're going to look at a cash flow estimate. So we're going to try to figure out how can you guess what the numbers are for an individual firm if you have cash flow statements and balance sheet, but also more generally. And then we're going to be using financial options and doing risk analysis. And once we kind of have those concepts, we're going to figure out a strategy. So once we have these tools, how do we use them to achieve our goals? So corporate valuation will be a first order concern for us as financial managers from the firm. We'll also look at different corporate decisions of repurchases and dividends. We call that payout policy. Do we buy more of our stock back or do we send cash to our shareholders? We'll look at capital structure decisions. How do we mix the debt and equity of the firm? Is there an optimal mix of debt and equity of the firm that gets us a lower cost of capital, and so on and so forth? And then other very real world applications, mergers, acquisitions, how to deal with financial crises. And lastly, if time permits, we'll get into public and private markets and how they differ. So the role of financial managers within the corporation. Within the corporation, and again, there are many different forms of corporate structure that all have different pros and cons that I'm sure you've got into if you've had a class on business ethics or had a class on another class in corporate finance. Here, we're going to take as a given that we're really going to be looking at a corporate structure, specifically at an incorporated firm. So the key features, you have a legal entity that's separate from its owners and managers. You have to register with the state. Many companies register with the state of Delaware. It's kind of a fun fact. If you look it up, you'll find most companies in the US are registered with the state of Delaware because it's a very easy state to be incorporated in. You have limited liability. What does that mean? Limited liability means that we're going to limit my potential to lose to whatever I put into the company. So if I'm a shareholder and I own this company and you are managing the company and somehow something goes bad and a lot of people are suing the company, the lawsuit will be limited to the value of the company and not my personal wealth. So that's sort of the main idea. And when you have limited liability, it's going to make it really easy to sell shares of a company because now I know that whatever I buy, my loss is going to be limited to the amount that I've put in. You're not going to be able to come after me personally. So let's talk about that corporate structure. You've got corporate owners, we've got investors, and then we've got stakeholders. So let's start with the smaller circle, our owners, our shareholders. Our shareholders own the firm. These are the equity owners of the firm. So the shareholders, because they own the firm, they get to decide who we hire as a CEO. They get to decide who sits on the corporate board. They basically decide how the firm, what's going to happen with the firm. The shareholders don't run the firm. The managers and employees are going to run the firm. So we'll get to them in a second. So we've got our shareholders. Then the next blue circle are our investors. That includes our shareholders and our debt holders. This could be banks. This could be our bond holders. These could be the holders of our commercial paper. These are the investors. In terms of a payout policy, even though the shareholders own the firm, they have a residual claim on the firm, meaning that they get paid out after the debt holders get paid out. So we have our investors, shareholders or debt holders, and then our very last circle are our stakeholders. And here is where we'll place our managers, our employees, our customers, our suppliers, our governments, basically any and everybody that's affected by the corporation. So stakeholders more generally we'll think of as sort of anyone that affects the company or anyone that can be affected by the organization's actions. And again, that can include many. Our owners, our customers, our governments, our suppliers, our lenders, our community, society more generally. So why do we think that corporate finance matters? Very quickly, you can observe that there's going to be conflicts of interest between all of these stakeholders, between our various investors, even between our shareholders, even within different groups of stakeholders like employees and managers. Everyone has a different definition of what doing well means for the company. Our shareholders might want the company to have the highest valuation possible. Our employees and our managers might want the company to be the best place to work. These are all different. They don't have to be in conflict, but they are conflicting interests. We also have conflicts between shareholders. So controlling or large shareholders may want the firm to behave safer if you've got a ton of your personal wealth locked into the firm versus a small shareholder or someone that owns many pieces of many companies. You might want the company to take on a lot of risk because you're well diversified. And the same thing with our shareholders and our debt holders. Our debt holders may want the company to behave safely so you can get a high return on your invested capital. And our shareholders may want the company to take on a lot of risk in order to have that capital worthwhile. So we just have different conflicts of interest. In addition to these conflicts of interest, we also have frictions. Frictions are things that make the real world different than the stuff that we talk about within the textbook. So a great example of a friction is that capital is costly. It actually costs money to get your hands on money. That's why we have a cost of capital. Because capital is costly, some of the financial decisions that we want to make are going to be affected by whether or not the funds we can get our hands on are expensive or not. We also have limited information. So we're always dealing with uncertainty. We're always forecasting. We never know for sure what's going to happen. So given that limited information, given the time horizons of our information, given the fact that not all information can be long-lived or infinitely lived, we're going to be always dealing with forecast and with uncertainty. We also have asymmetric information. So managers probably know more about the firm than shareholders. You probably know more about your ability to follow this lecture, do math, whatever, than I do as someone who's providing it. We always have different sets of information, and how we communicate that information or what that information tells us or what we can infer from that information, the signaling, it's going to have a very real financial effect on the decisions that make sense for our corporate manager. We also have taxes, we have financial distress. Financial distress, you can think of it very easily as, I worry what happens when you can't pay back your debt. When you can't pay back your debt, you're going to go bankrupt. You may take on even crazier actions in order to be able to pay back that debt. So a classic way of thinking about this within economics is you could think of moral hazard. If you have a credit card that has a 30% interest rate, you might start doing really wild things in order to be able to pay off that credit card. And then lastly, we have irreversibility. Plenty of the investments that we make can't easily be undone. So think about walking around the university campus, think about a sports arena, think about a building. Not all buildings can be easily applied to a different setting. So because a lot of our investments will be irreversible, sometimes it'll be beneficial for us to wait, to gather more information, to let this uncertainty resolve before we decide to take a large investment. The opposite could also be true. There are plenty of scenarios where waiting won't really offer us any opportunity to have this uncertainty resolve. So we're better off just moving forward with the limited bit of knowledge that we have. So it all varies. Okay. Given that we have all this stuff, all these moving parts, what should be the financial manager's main goal? So the primary objective should be to maximize shareholder wealth, which means maximizing the stock price, but you have to do it ethically. So we're not going to try to maximize the stock price no matter what, because very clearly we'll observe that there are ethical dilemmas, again, given this conflict of interest. So should firms behave responsibly? Yes, of course. Remember, our stakeholders included everybody. So what does it even mean to maximize the stock price? Well, the way that we'll think about it within this class is that the value of the firm, it's really the present value of all of these free cash flows. A free cash flow, it's the sale revenue, less the operating costs, less operating taxes, less the required investment in operating capital. So you're selling computers. You sell computers. It costs money to make those computers. So you have an operating cost. You also have to pay taxes on what you've earned. So you have operating taxes. You also have required investments in capital, in your warehouse, in your production, in your staff, in your people. So all of that is money that you still have to spend. So the free cash flow, it's what pot of money is available for you to pay out, for you to distribute to investors, your stockholders and your debt holders, your creditors, once everybody's been paid for. And that really is the way that we'll think about valuing the firm. How much money is left over once everything else has been paid for. You'll notice two things. First, every free cash flow, FCF, has a little subscript of like a 1, a 2, all the way up to infinity. And you'll notice that the WACC, the weighted average cost of capital, the denominator, has the same thing going on with the exponents. What are we doing? We're discounting the free cash flow for each time period by the appropriate discount rate, which will be the weighted average cost of capital. You'll notice that the free cash flow that's 2 time periods away, it's being discounted by 1 plus the WACC squared. And the same thing through infinity. So we sum, it's the infinite sum of all of these discounted future cash flows that creates the value or the stock price of the firm. The other thing that I hope we kind of notice, if these free cash flows are different, which they can be, And if the weighted average cost of capital is different, which it very well can be, then we've got a lot of complexity. So we'll try to keep things simple and we'll try to figure out what could be the average or expected free cash flow of the firm and what could be a reasonable or a sensible estimate of the weighted average cost of capital for the firm. So what is that WACC, that denominator? The WACC is the average return required by all of the company's investors. So our debt holders have a required rate of return, our equity holders have a required rate of return. When we take a weighted average across all of these different investors, we're going to basically know what our actual cost of capital is as a financial manager. What can affect the WACC? Our capital structure itself can affect the WACC, meaning how we split up our financing between debt and equity can actually affect our cost of capital. Our cost of capital, our WACC, is definitely going to be affected by interest rates. If we're in an environment with very low interest rates, then investors are going to have a different required return than if we're in an environment with very high interest rates. The same is true for the risk of the firm. The kinds of things that we're taking on are going to have different required rates of return given our set of investors. And then lastly, also our investors' risk appetite. You can guess that how you feel about risk during a crisis or during a pandemic is very different than how you feel about risk during an expansion or during a boom in the economy. So these are all things that can affect our cost of capital. Very briefly, let's go through a course outline. So we're going to start with capital budgeting. Our next lecture will be a refresher on our discounting cash flows. So we're going to apply our perpetuity formula, our annuity formula, amortization, basically paying off a loan bit by bit. We're going to look at using the appropriate discount rate, and then we'll take quite a bit of time to kind of make sure we're good on NPV. Then we'll look at managers and market efficiency. So we'll talk about risk and return, corporate governance, what is the role of the financial manager, and then we'll get into the cost of capital. Forecasting cash flows, so we're going to build pro forma financial statements. You're going to forecast cash flows for a firm. And then lastly, we'll get into financial options and real options. So how do I use a portfolio of calls and puts as a financial manager, given that I'm really worried about the expected price of corn futures? Let's say that you work as a CFO for a really large manufacturer, and you're very concerned about the spot price of iron, or you're very worried about the potential cost of electricity. Is there a way for you to use calls and puts to help reduce some of that risk? The answer will be yes. And once we have those tools in our hands, we're going to apply that same thinking to the actual options of the firm. So if it's worthwhile to wait, if it's worthwhile to abandon a project, how valuable is that? That's going to be real options. So we'll talk about that. And then we'll get into the firm's dividend policy. So dividends are more generally referred to as the firm's payout policy. How do you pay out that free cash flow to your investors? If we're in a world where there's no frictions, where there's no information asymmetry, there's no taxes, there's no agency concerns, I know that all of you are doing really hard work as managers, and I don't worry about any of that, then it really doesn't matter how you pay out cash to the firm. And it sounds counterintuitive, and we'll go through many numerical examples to convince you that payout policy, how you pay out this cash, it really only matters if we're in a world with frictions, meaning we have incomplete information or we have financial distress. If I don't know everything that's going on, then your decision to pay a dividend is a signal of your firm quality. Your decision to cut a dividend might be a signal of your firm quality. And we'll also talk about share repurchases. Dividends themselves have been dwindling on aggregate across the market, but share repurchases have been have been really going strong for at least 10 or maybe even 15 years, depending on the data you look at. So we'll talk about share repurchases as an alternative to dividends. And then we'll also look at cases where the share repurchase is a signal. We'll get into capital structure, the mix of debt and equity, signaling firm quality with changes in capital structure. So we just said with repurchases, if you want to recapitalize the firm, what are you telling us? Are you telling us that the firm has some really good growth opportunities, and that's why you want to reduce the amount of debt outstanding? All of it. And then lastly, we'll get into applied topics. So we'll look at the management of risk using derivatives and other hybrid securities. Again, like we said, we'll talk about how to use different option portfolios, mergers and acquisitions. If I'm going to go buy a firm, what are the conditions under which I would do that? How costly is it to go buy another firm? Are there advantages to basically having different or reduced financial distress through corporate takeover? All of it. And so if time permits, hopefully we'll get into public and private financing. And then lastly, we'll have a chance to talk about different periods of market dislocation, of different financial crisis periods. Okay. So this week, we're going to go through time value of money, NPV, annuities, perpetuities, amortization, paying off a loan bit by bit. And then next week, we'll get into the role of the financial manager. So basically, what decisions does the manager make? We'll talk quite a bit about market efficiency under certain conditions, how are securities priced correctly. So the next set of things that you'll want to look at to prepare will be chapter 1 and then chapter 4 for the time value of money. Thank you.